Let's talk media. Paramount Global shares rising after the company reported a profit in its streaming division, also announced it's cutting 15% of its workforce. But the stock's still down 25% year to date, and the company's linear TV networks in some tough shape. So let's talk about that. Let's also talk about Warner Brothers on the state of streaming, including those headaches that it appears that Warner Brothers is struggling from. LightShed Partners' Rich Greenfield is here. Good morning to you. You want to talk Warner Brothers first? You want to talk Paramount first? Your dealer's choice.
This was a tough week, Andrew. I mean, what we're learning, right, is that the pace of cord cutting is certainly accelerating. I mean, this is not a new phenomenon, but it's definitely getting worse. And I think what really spooked investors just broadly is that as you've seen sort of all of these, what we call legacy media companies, they've all told investors they're going to get to profitability in streaming. And they all are. I mean, you mentioned Paramount. Disney announced its first combined profit. Like, they're all improving, but it's how they're improving, Andrew. They're improving by slashing the amount of programming, cutting back on marketing, and jacking the price on consumers. They're not doing it because consumers are like so in love and willing to pay more and spending so much time. Like, it's a pretty depressing way of making money.
Well, so that was my question. Long term, you look at a Netflix, obviously super profitable at this point. Do you see a path to which Disney, which of course now just a quarter faster than they thought, gets to profitability that ever looks like Netflix?
I think it really depends on willingness to invest. I mean, what you need to win in streaming, if you're going to be, you need to be global. I think everyone, Zaslav has talked about the importance of global. We agree with David. Like, you need to be global. This is a global game. But you also need to invest in a tremendous amount of content. The way you keep subscribers is by having them absolutely love your service, where you can't live without it. Like, people can't live without Netflix. They can't live without Spotify. To make these streaming services must-have, you need lots of content. The industry seems to be actually going, hey, we have a churn problem. We can't spend enough on content. So what we're going to do? We're going to go back to that old thing called the bundle. And we're going to try to stuff as many things as we can into a bundle so that it looks a little cheaper. We tie them all together so you won't churn. It's not exactly the most consumer-friendly thing, shoving things in that you don't all want at the same time just to cut the price. Why not just price the service where it actually has the right price value to the consumer?
Well, the problem, of course, is if you price it where you think it would have the value to the consumer, it would be a lower price. And then you have a margin problem all of a sudden. Look,
you need to build this. There's no cutting corners. There's no like skip the line and jump to the front. Building streaming is, if you think about the building blocks, it's invest in content, get consumers completely engaged where they're obsessed with it, raise the price, invest in more content, drive more time spent. Like, it's a very clear, the way you do this properly is consumer love and getting people to be obsessed. We all agree.
I think we're in violent agreement about that. My question to you now is, we've got on the screen Netflix, Walt Disney, Warner Brothers Discovery, and Comcast. Okay, and we could put
the market's
Paramount
telling
on that
you
list
these companies can't do it.
Excuse me?
The market's telling you The market's telling you, Andrew, these companies can't do it. I mean, look at the way these stocks are trading. I mean, forget about what happened this week. Like, look over the last several years.
Correct.
These stocks are all destroyed because the market doesn't believe. They believe the core business is getting worse, and they don't believe streaming will be successful enough.
So my question is, would you buy any of them? Would you buy some of them? Would you short some of them? What would you do here?
I mean, I would continue to buy Netflix. I think everyone cutting back is basically handing this industry to them. They're handing it over to Google and YouTube, right? Like, just the amount of time spent shift that is happening. And I would look for other companies that are benefiting from this consumer love of streaming. Look at something like Spotify and look at how much progress they've becoming a real business over the last couple of years. I think you have to look much more broadly across the media space for great ideas. This is a tough sector. I don't think you can there's no pretty house on a bad block.